I totally agree that every day is a good day to invest, but there is a small disclaimer. And now this disclaimer is going to help you to decide whether investing into equity market is going to make a lot more sense to you for your personal businesses and your personal family money, right? And the disclaimer is as such. Every day is a good day to invest, but what if you have a commitment on your books in next 6 months, you need to pay a lump sum to your probably house loan, a lump sum to your college expenses, a lump sum to your schooling expenses, a lump sum required for your family purpose. Will that be a right decision to invest into equity if you have a duration of 6 months in hand? Now, who decides that 6 months is the right duration, or 12 months is the right duration, or 3 years is the right duration for an equity market? And there's another common challenge over here. To each and every one of you, I ask a common question. What do you mean when we say stay long term in equity? Can you write the years which you feel is the right year to use the word long term in equity and stock market? A lot of people say long term in equity is a good idea, Nikhil. If it is a long term investment, we should invest the money in equity. A lot of people speak the same language. What do you mean by long term? So 10 years. Can I have every one of you to write a certain number? What do you mean by the word long term? 5. Participation brings value. So the more you participate, we get to know. How do we think? Great, 10 years. Awesome. Awesome. Can we have one more? What do you mean by long term with the way you feel long term is all about? One more person mentioning. Okay. So yeah, I could see that there are answers right from 5 year to 10 year. For few people, it's 3 years, and long term has been very different for every individual. Now, here is a point, friends. Long term will totally be decided based on your current age, the timeline available in your hand, and the market offering the opportunities. Just 5 years before, when somebody asked me long term, we were comfortable to say that if you have a holding capacity for 3 years, investing into equity would be an awesome decision to make so. If someone asking us today that I would like to invest and I'm going to keep the money for the next 3 years, would that be a good reasonable timeline to invest into equity market? The answer is questionable. The answer is debatable. One may say it's a growing economy, which I've been speaking to you in the past webinar. All well said, great, awesome. Market is at its peak of the current month. Market may peak again the next month to the further peak. But the question here is the price earning, is actually the corporate creating that kind of earnings for all these people to actually put the market at these levels? Now, who are these people who are putting this market at this level of 11,500 Nifty points or whatever Sensex points? Friends, please understand, the behavior of current market is nothing but the future expectation from this market. If you and me have already purchased a Reliance share, it means I expect Reliance shares to do well, right? And that's why you purchase a Reliance share today. So if today the whole Sensex and Nifty are trading at that level, it just means that people believe the market is going to be robust and they've started investing in the market. The good news here is, in general, our stock markets have performed extremely well with the foreign investments, the FII investment, the foreign direct investment through institutional buying and much more. The good news this time in this market picking up is we have huge amount of domestic investor, a very huge amount of domestic investor participating in the market. In fact, exorbitant, never seen before in Indian equity, this kind of domestic investment. What are the reasons which brings these kind of domestic investments here in the market? So you all have to understand this, that the real estate market in general across India are not being the favorite choices of the investor. People are skeptical about investing into real estate. The gold market is not favoring for people to do an exorbitant wealth creation. Hope you all agree with this. The third reason could be the markets were offering an interest into fixed return near about 10% in the past. But today the market is offering a fixed return of 6.5%. Then where do I put my money? If I am not believing into real estate, gold, or fixed instruments, where do I put my money? So what happens when market has some positive response through whatever reasons? People want to move their money and diversify in this equity portfolio, because many people have understood in the past staying in equity market gives two great opportunities. How many opportunities? Two. What is number one? After 365 days, the returns are tax-free in nature. The returns are not taxable in nature. The second opportunity is they can liquidate the money whenever they want, any moment they want, and they can utilize the funds in any sector they like. So these two reasons have become a lot of people happening to participate in equity market. Is that India suddenly changes its culture and tries to understand that we all believe in equity and equity is going to do great for me. And as some of the participants mentioned, 10 years is a long term, 5 years is a long term, 7 years is a long term. Truly, are people staying in the market for 10 years and 15 years and so on and so forth? The statistics shows the duration of people in general, the resistance, the average time they stay in the system is near about 3 to 3.5 years. There are very few people who truly stay back in equity as long as that it is possible. And those are the people who are making exorbitant wealth. And those are the people who enjoy with your mistakes. If you're one among those who liquidate your money as soon as you feel, oh, now the market is high, it's good that we liquidate our money and we are out of it, right? You are the reason who are giving opportunities for rich people to buy money from in the lower markets. When I say you, I mean all those people who actually invest thinking long term, but start withdrawing money. Oh, market is peaking, market is already high, I should not be staying further in the market, I don't want to take any kind of risk, this money is so valuable for me. And you have all the reasons to stay in the market, all and so many reasons. But what happens in general, while you're investing money, this money will be going to stay for long term. I'm not never going to touch this money. This money is not required to me at this moment and I will not be touching it. But your behavior changes as you see the money growing or diminishing or appreciating, your behavior changes. Why do we change this behavior? Do you truly check into real estate every 6 months, 3 months, what is the price of the real estate, how the market is doing, the area where you purchase the real estates are good or bad? Do you actually check when you buy a gold and keep checking the rates of the gold market? Are they really doing good? Is that I need to hold it or not? Do we actually do that? Think about this. We not. But when it comes to equity, somehow mind says, let me check, because you have accessibility on daily basis to check the rates of equity market. Hope you agree. Now the biggest question is this. We understand the behavior of the people. We understood the people participating in the growth of this equity market are domestic investors. And now if you see the foreign money, the FDI and FI monies have started pumping in this country and further expected to pump huge. And what all the more has happened, which has contributed this market to be of this level? You and me understand what happened in the demonetization, right? We suddenly saw a lot of money getting inflow. The money which was stuck in the cash form in the economy has actually gotten to the bank, and now people want to invest money from their bank balances wherever they can invest, and they have participated in equity. What happened in GST? Most of the business owners have started seeing money coming into banks because of the GST purpose, and now they can have more access to bank money, and when more access to bank money actually leads more participation in instruments like equity. Even that has complemented the whole equity market raising in the level in which it has been raised. Now there are few things which I want to share with every participant in this particular webinar. If you see, there has been an amazing career. Would you like to know the sectors where you can actually expect some kind of performance in this peak market? Would you like to know the sector? If the answer is yes, please write yes. Would you like to know? Please write yes. You like to know the sectors, or show your hands. Excellent. Excellent. So let me share sectors which may help you and may help you to understand whether your participation in those sectors will make a difference or not. In this rallied up market, we saw the pharmaceutical sector had a huge correction. Of the only sector which actually did well was the pharma sector. There was a lot of rebalancing things, a lot of the compliances getting changed, a lot of challenges in the pharmaceutical sector, which has brought this sector down to a good amount of percentage. And this was a sector which was doing extremely well when the markets were flat, when the whole market was sleeping. And only pharma was performing. And when markets started performing, pharmas are the sector which got corrected very, very nice. Way forward, is pharmaceutical sector very good? I'm sure I need not explain you the importance of pharma sector in the whole world economy, and especially Indian economy. For the kind of population India has, I'm sure you understand, fear is getting sold, and because of fear getting sold and because of poor lifestyle, challenges, headache, pharma industry is rocking, and pharma is going to further rock. I would say, if you need to have a contra bet in this kind of market, these are my personal recommendation. Let me make it a great disclaimer here. I have personally not invested my money into pharma sector. I personally not an investor when I actually advise. Yes, we manage our clients' funds. We help them. We are not supposed to do that because at times we become biased to the sector which we are. But these are out of my in-house research and we understand the sector. If I need to bet my client's money, I would recommend pharma sector could be one of the choices which client can make in his overall portfolio. Pharma is a sector which will help you contra in this market, which can add more to you. There's a second sector which can help you more in this market would be FMCG sector. Which sector? FMCG sector. FMCG sector is another sector which can continuously perform. And this is again going to be more of comfort in this peak market to be a part of it. Hope this is already adding value to you. If the answer is yes, please write value if this two information is already value to you. I could see your hands. If this is already a value, please write value, right? Now the question lies over here, my dear friends. Well, good, I get to know the sector, but Nikhil, we don't trade into direct stock markets. I understand you don't directly trade into the stock market. Today's topic of this webinar was more to do with the stock market because I've been receiving calls every day of so many people. Hey, tell me what to do, tell me what to do. And I somehow thought if I can route them all through webinar and if I can spend the same half an hour to give the same information, and that's the reason I could see so many new people coming to be a part of this webinar. Welcome all. Thank you to be a part of this webinar. However, now the question remains, I don't invest into stock market directly, neither I understand which script to buy, and I don't know when to exit out of that script. Great, I completely understand. Then what is the second option? You all know the second option, which is mutual funds. Through mutual fund, you can give it to fund managers and fund managers can make the decision to buy. Now the question remains, is it good to buy a sectorial fund like pharma and FMCG in mutual fund? Let me make this very, very clear, friends. If you are a first-time investor, I don't want you to buy pharma and FMCG and have only part of your portfolio. Not at all. I would rather say it will be advisable that you can make pharma and FMCG a part of your portfolio, which will help you to well diversify. Now, what are the areas I personally feel that one has to be away from? Special areas, sectors, which you should be away from. Would you like to know? Then please write away. Away. Write away for me to understand you want to know which sectors you need to be away from. Only one person wants to know away. Which sectors you need to be away from? Okay. 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 Awesome. I can see your hands and away. Well, thank you. Friends, now sectors. To what I understand at this moment, I would try to, we are already working to speak to every client of ours and trying to rebalance the portfolio, as we personally feel there's a great opportunity to rebalance all the old portfolios, because we personally feel these are the sectors where we should not be staying longer at this moment. And the sectors are as follows. We think we should stay away from the small cap funds. We should stay away from these companies which are smaller in nature at this moment. I understand there would be some great smart companies who are doing extremely well. After the research or with the experts, I would advise you to further invest the money into any small cap companies. But if you ask me personally, small cap is a highly volatile in nature. Small cap is highly volatile in nature. The companies are doing extremely well, further will do extremely well, but it also has its own negative effect when market sentiments are not right. People tend to pull out money. Look, I'm advising it from my point of view. People tend to pull out the money. Small companies require liquidity. Liquidity, when it's pulled out, the performance of the small company absolutely changes. And for them to access money from the market is not so easy the way large cap company has access to the market. Their ratings are different. Everything is different. So they have challenges. The second area which I would like you to stay away from, I would say you can minimize your portfolio to greater extent, would be your mid cap industry, the mid cap side. The mid cap is, again, if market has to have a rebalancing done, it will highly affect the small cap and mid caps, is my assumption, which I feel based on whatever charts we've been seeing over a period of so many years, and we have seen the markets behaving in different way. I would say stay away from small cap and mid cap. Okay, friends, mid caps and small caps. Now, the third thing, would you like to know then what kind of funds we should be buying? I'm not going to say you a large cap because I've missed that. No. You like to know what kind of funds, what kind of investment I should be doing. If the answer is yes, please write yes. I would like to know. Write yes. Write yes. I will understand that you want to know which kind of investment then the portfolio should look like. Okay. So I will be dividing this into two, friends. Great. Thank you so much. It's the whole idea behind your reply is just that to keep you engaged, to understand that how focused you are, and also helps the energy level to go up in this webinar. And that's the reason why I asked for reply. And when you reply, you are more accountable for your decisions. Well, now the question here is, friends, how does then the portfolio should look like? So let us split this into two. I assume there would be a first-time investors in this group as well. And there would be few investors who are already been investing. How do I rebalance them? If given a choice to me at this point of time, this is how my portfolio would be designed probably. I would like to put my money, I would like to give to a fund manager where I give him the total rights and authority to utilize my fund right from 30% to 70% exposure in equity. How much percent? 30% to 70% exposure in equity. Let the fund manager decide what he would like to, which sector and what he would like to invest. Now, what happens with any mutual fund company, fund managers? You may say, hey, they are not doing well, my money is gone down. Please understand, if the fund name is XYZ small cap fund, XYZ company small cap fund, you have invested into a small cap fund, he's bound to invest your money into small cap. And if small cap happens to correct, obviously your portfolio will correct. But there will be a fund manager who's sitting on large cap and you have invested your money into large cap funds, correct? Your money will also correct. It will also again go down. So fund manager is actually behaving based on the behavior. Fund manager behaves with the money based on the behavior which the fund expects. And when you buy a particular fund in any mutual fund houses, The fund has its own philosophy and they stick around to their philosophy and pattern, right? I'm trying to say, how about this? Buying a particular fund whose philosophy helps the fund manager's expertise, to leverage when he feels appropriate to invest in the market, he will invest. 1 point. 2 point. Wherever he feels appropriate about it. If he feels appropriate to put higher in large cap, mid cap, small cap, he's more than willing to do that. But we are saying that we want more of a large cap exposure so that we minimize the risk reward ratios, right? Now, I would say the portfolio would look like this for me. If I am a first-time investor, I would advise every person to enter this market. If you have a big lump sum in your hand, enter the market with a balanced fund approach. What approach? Balanced fund approach. Now, balanced fund has a lot of different colors. Balanced fund is just not balancing. Okay, 50 here, 50 there. It doesn't work like that. Balanced fund can be right from 20-80 ratio, 70-30 ratio. It just changes. And there are different philosophies. Probably in balanced fund, the market must be having an offering of more than some 100 plus balanced funds available. How many? 100 plus different balanced fund available. So, but we need to figure out where the fund manager has the control on the philosophy of investing at the right time he feels like. He is on the right chair, right? And the sector which he feels like. And I would recommend go to a balanced fund which has this option available, where fund manager decides, not the theme decides. Okay, this would be for the first time investor. And for the first time investor, no, I don't want to go conservative. I want to be participating in the market. Nikhil, come on, Nikhil. One way you say you need to be a part of equity. One way you say long term. I need to be a part of market. I'm sure I will not touch the portfolio for next 10, 15 years. It's a very long term portfolio. Okay, friends. In that case, you like to know where to put your money? Put your money up along with your balanced fund approach. Put your money into any large cap focused fund, any large cap focused fund, blue chip funds. You can put your money there. Large, when I say large, it has to be truly large. Okay, there are funds which in the name of large cap has a very big diversification. You need to be on truly large. Those funds will probably help you to at least start with this market in a perfect way. That would be my recommendation. Number 2, for the startup in equity business, for the people who are going to start putting their money for their long-term goals in equity market, a balanced and this will be good. Now for people who already understand equity business, now for people who are already an equity participant for their long-term goals and desire and dream, what is my suggestion before I sign off? Would you like to know, for people who are already an investor in equity, how many of you are already investor into equity? Can you please say I? Already an investor into equity from quite some time. I. Okay, awesome. So there are a few people who are already an investor into equity. Now for people who are already an investor into equity, these are my just recommendations. Okay, if you have a portfolio which has been serving you for almost 15 years, 20 years, 10 years, and it's quite structured already in place, I would say don't touch your portfolio. Do not touch your portfolio. I repeat, do not touch your portfolio. But if you have been already an equity investor and in recent times you have participated in equity, in that case, I give you a balanced approach which you can actually start developing it. 1, you can be a participant in a sectorial fund like pharma. Normally, and in industry, nobody suggests any sectorial fund because the common myth here is it's a very high risk. You're only putting in that sector. But friends, in sectors also some portion of diversification is done. It's something like putting your money into infrastructure fund does not mean that the whole money is only going into land and building. It also goes to banker. It also goes to cement manufacturing company. It will also go to steel manufacturing company. It's a whole bunch of diversification within infrastructure. Likewise, for pharma fund, which I mentioned in the beginning, and for your FMCG fund, you can participate small part of your portfolio into those two sectors, a small part of your portfolio. Third thing, which people who are already an investor can do is, you can move from your small and mid cap to the large cap, from your small and mid cap to the large cap funds. So you can funds or the large cap scripts, whichever you are dealing with respectively. You can move little bit of direction over there to minimize any kind of major volatility going forward in the direction of the market. You may enjoy the time only because you will have some money into these kind of sectors. Probably even if the market is not performing or flat, there will be in a position to at least generate some kind of wealth, is my assumption out of it. Now, third thing you can do is, even if you're an equity investor and recently you build your portfolio, I would suggest strongly you build a good amount of money. The old investors have on an average got 18 to 20% of wealth. For people who have newly invested, would have got an average wealth of more than 25 to 35% on an average. Okay. Now for people who have got 25 to 35% on an average, I would strongly recommend you to jump your money into balanced fund, which I mentioned, 30-70 fund manager taking a decision, or put your money into large cap funds and do a systematic transfer slowly to the scripts you like in small cap and mid cap once again restart. Do a systematic transfer from your large cap slowly to your small cap and mid cap funds, or to your small cap and mid cap scripts, to small scripts and mid scripts. Okay, I would advise you to do that. Now, for even the old people and even the new people and even the people who are first time investor in equity, would you like to know what is that commonly you can do at this market? If you would like to know, use the word common. This is a common suggestion, right? Awesome. So there are people more who is interested to know common. What is the common advice I would rather give you to participate in this market? I would simply say, if you have a lump sum in your hand, invest your lump sum at this moment into the balanced fund approach and do a systematic transfer in the sectors which I have spoken to you, which is small cap, mid cap, large cap funds. Why I want you to do, when I say in one end, you can stay away from small cap and mid cap. On the other end, I'm saying to put the money into small cap and mid cap. It simply means that sector is highly volatile in nature. And because you're going to do a systematic transfer from your balance fund to this fund, or you don't have a lump sum, but you're starting with certain amount of 10,000, 20,000, 50,000, in that case, you can have any kind of portfolio going forward. I'm using the word any kind of portfolio going forward, any kind of portfolio. For the simple reason, you are sitting at a kind of market which actually is being told as overvalue. Overvalue market in terms of the data. Now, who decides what is overvalue? If suddenly NS Financial Services is growing good, now who decides the overvalue? We are doing good, simple as that, right? But however, if a common advice would be that if you are putting your money month on month, you don't have a corpus, you don't have a lump sum, please put in all these sectors. Rather, I would say, please invest money into multi-cap sectors. If you're a mutual fund kind of people, invest into multi-cap fund or diversified fund. Multi-cap fund or diversified fund. In that also I can tell you which kind of funds you should actually pick up, which actually hedges a lot of risk. I can also tell you which kind of balance fund you can pick up, what is the fund name, which will help more to you. I can also tell you which pharma is much better. But what is more important in today's webinar is to understand how do I behave in this kind of equity and stock market. And the behavior has already been explained to you last 25 minutes. I would only say one thing, friends. Equity investment should be, must be part of your overall portfolio. There's no question that you can't have an equity portfolio. Traditionally, it has been seen that people don't encourage more in equity. I don't understand all those people who have huge amount of real estate but not participating in equity. I don't understand that logic overall. However, there are people. Well, I would say I'll end this conversation of today's webinar by giving you a quick recap. Recap is as follows. If you are a common investor entering in the market with some money, then there's no problem to invest into any sector, large cap, mid cap, small cap. And the advice would be, if you're going through mutual funds, please have a diversified or a multi-cap sector. If you're a person who has a lump sum, I would advise you at this point of time, who's already been an investor, please put your money into large cap funds or the balanced fund and start doing a systematic transfer to mid cap, small cap and other sectors which you are liking. So if you're an investor who's a first timer who had never invested in equity in the past, first timer, I will strongly recommend you to please have the balanced approach, which I told you about 30 to 70, and allow the fund manager to decide whether he needs to be in the equity market or not. And you please don't decide, because you're a first time investor, and don't listen to anybody and everybody. If you have money coming monthly in your hands, in that case, I would advise that you can build a diversified portfolio and start putting monthly money for first time investors. If, friends, you are a guy who is directly dealing in stock market and you are really interested to know which sector to focus, then as I mentioned in the past, pharma and FMCG sector looks to be good going forward in this peak market, because they were underperformers quite some time, and there are reasons for these sectors to do well going forward. We can speak about the reasons in detail maybe in some other webinar, if any is conducted like that. And for friends who wants to know which kind of sector I should be working upon in direct stock market, then the answer is very clear. Stay away from small cap and mid cap companies and try to participate more in large cap companies if you're directly dealing in stock market, even the large cap funds.